October 29th, 1929. A day that would forever change the course of history. A date etched in history, remembered for its devastating impact. A day that witnessed the collapse of dreams, the evaporation of fortunes, and the onset of an economic catastrophe that would scar a generation. Families were torn apart, businesses shuttered, and hope seemed a distant memory. This was Black Tuesday, the day the American stock market crashed, plunging the nation into the Great Depression. The ripple effects were felt far and wide, affecting every corner of society.
The New York Stock Exchange, once a symbol of prosperity and boundless optimism, became a scene of chaos and despair. The bustling hub of financial activity turned into a ground zero of economic ruin. Investors, gripped by panic, frantically tried to sell their stocks, but there were no buyers. The market was flooded with sell orders, and the value of stocks plummeted. Share prices plummeted, wiping out billions of dollars in wealth. The financial stability of countless individuals and institutions was obliterated in mere hours.
The ticker tape, struggling to keep up with the volume of trades, ran hours behind, adding to the confusion and fear. The delay only exacerbated the panic, as investors were left in the dark about the true extent of the losses. Black Tuesday was not just a market crash, it was a symbolic breaking point. It marked the end of an era of unbridled optimism and reckless speculation. It shattered the illusion of invincibility surrounding the booming economy of the Roaring Twenties. The vibrant, carefree spirit of the decade was replaced by uncertainty and fear. It exposed the fragility of a system built on speculation and overconfidence. The foundations of the economic boom were revealed to be unstable and unsustainable.
Most importantly, it marked the beginning of a long and arduous journey through the Great Depression. A period that would redefine the American experience. A period of unprecedented economic hardship that would test the resilience of the American spirit. The nation would have to come together to overcome the challenges and rebuild from the ashes of Black Tuesday.
The 1920s, often romanticized as the Roaring Twenties, was a decade of profound social and economic transformation. It was a time when society seemed to be dancing to the rhythm of change, embracing new ideas and lifestyles with an almost reckless abandon. The post-war economic boom brought about a period of unprecedented prosperity, particularly in the United States. This newfound wealth was evident in the rapid expansion of industries and the rise of consumer culture. New technologies such as the automobile and the radio fueled consumer spending and economic growth. These innovations not only transformed daily life, but also connected people in ways previously unimaginable.
Cities buzzed with a newfound energy, becoming vibrant hubs of activity and cultural exchange. Jazz music filled the air, its lively and improvisational style reflecting the era's spirit of freedom and innovation. Flapper dresses became a symbol of the era's social liberation, representing a break from traditional norms and the embrace of modernity. The stock market, reflecting this optimism, experienced a dramatic surge, with stock prices reaching unprecedented heights. However, beneath this shimmering surface of prosperity lurked dangerous economic practices that were setting the stage for disaster. The apparent stability was in reality a fragile facade.
One of the most significant factors contributing to the impending crisis was the rampant speculation in the stock market. Investors were driven by the allure of quick profits, often ignoring the inherent risks. Fueled by easy credit and a get-rich-quick mentality, millions of Americans, from seasoned investors to everyday citizens, poured their savings into the market. This widespread participation only served to inflate the bubble further. Stock prices were driven not by the underlying value of companies, but by speculative bets on their future growth. This disconnect between price and value created a precarious situation.
This created a dangerous bubble, inflated by unrealistic expectations and a collective belief in perpetual growth. Unsustainable borrowing and over-leveraging added to the instability. The stage was set for a dramatic fall, a collapse that would bring the Roaring Twenties to a screeching halt.
The warning signs were there, but few heeded them. In the weeks leading up to Black Tuesday, the stock market had begun to show signs of instability. Prices fluctuated wildly, and there were a few smaller crashes. However, these were dismissed as mere corrections in an otherwise unstoppable bull market.
Then came that fateful Tuesday. The bottom fell out. Millions of shares were traded at ever-falling prices. As panic selling gripped the market, the ticker tape, overwhelmed by the sheer volume of transactions, could not keep up. Investors, watching in disbelief as their fortunes evaporated, were left with nothing but worthless paper.
The impact of Black Tuesday was immediate and devastating. Banks, heavily invested in the stock market, collapsed as panicked depositors withdrew their savings. Businesses, deprived of capital and consumer demand, went bankrupt. The unemployment rate skyrocketed, leaving millions jobless and desperate.
The American economy, once a beacon of prosperity, was in free fall. The Great Depression was a watershed moment in American history, a period that fundamentally altered the nation's trajectory. It forced a fundamental reassessment of the nation's economic system, compelling leaders to rethink the very foundations of economic policy and the role of government in regulating the market. This period marked a significant shift in how economic stability was perceived and managed. The lessons learned from the crash of 1929 and its aftermath continue to resonate today, serving as a stark reminder of the consequences of unchecked financial speculation. One of the most significant outcomes of the Depression was the creation of a financial regulatory framework designed to prevent a repeat of the reckless speculation that contributed to the crash. This framework laid the groundwork for modern financial oversight. The Securities and Exchange Commission, or SEC, was established in 1934 to oversee the stock market, promote transparency, and protect investors from fraud and manipulation. The SEC's role has evolved over the decades, but its core mission remains the same: and protect investors from fraud and manipulation. This was a crucial step in restoring public trust in the financial markets. The creation of the Federal Deposit Insurance Corporation, or FDIC, in 1933 aimed to restore confidence in the banking system by insuring deposits and preventing bank runs. This measure was instrumental in stabilizing the banking sector. Social welfare programs, such as Social Security, were implemented to provide a safety net for the most vulnerable members of society. These programs have since become a cornerstone of American social policy. Were implemented to provide a safety net for the most vulnerable members of society. These initiatives helped to alleviate some of the worst effects of the Depression. The Great Depression underscored the interconnectedness of the global economy and the importance of international cooperation. It became clear that no nation could navigate such crises in isolation. The Smoot-Hawley Tariff Act of 1930, which raised tariffs on thousands of imported goods, backfired spectacularly. Contributing to a global trade war that deepened the Depression. This act serves as a cautionary tale about the dangers of protectionism, contributing to a global trade war that deepened the Depression. The international repercussions were severe, highlighting the need for cooperative economic policies. The lessons of the 1930s, the dangers of unregulated markets, the importance of financial regulation, the need for social safety nets, and the interconnectedness of the global economy remain as relevant today as they were then. These lessons continue to inform contemporary economic policies and debates. By understanding the mistakes of the past, we can strive to create a more stable, equitable, and resilient economic future. The path forward is illuminated by the hard-earned wisdom of those who came before us.